Well, hello everybody. This is Ken Kavula from the Mid-Michigan chapter, and this is the July session of the Mid-Michigan Roundtable. We're so glad to have you folks from all across the country. We're especially glad to have the folks from the Mid-Michigan chapter. We're so glad that you can take time out of your busy days and your beautiful summer to join us for a little bit of talk about stocks. Tonight we're going to be joined with all of the Knights. Cy is with us from Atlanta. Hugh is with us from Southern California, and Mark, of course, is with us. Mark lives about 45 minutes southeast of where I live, and I live up kind of near Saginaw Bay, so the two of us are fairly close together. We have some legal things to get out of the way real quickly. This is a demonstration. Everything we're going to do, even though we're talking about real stocks, is an educational demonstration. We'd like you to do your own homework before you decide to buy or to sell a stock. We are dabbling in some experiments, and we'll identify what we're doing as experimental when we do it. We're testing some hypotheses to see whether they're going to work to help us improve our performance. But by no means are we finished with our tests and finished with our drawing conclusions from our tests. So beware when you watch us doing some things that might be a little bit strange. Think about them and comment on them. Help us make our decision about whether some of these things are going to add to the tried and true that we absolutely believe in. We might hold some of the securities that we talk about in our own portfolios or in those of our clients, and we'll try to tell you when we own something as we talk about it. Our agenda is fairly standard. We're going to do look at the scoreboard. We're going to look at some challenges. We have 4 stocks to present this evening, some of them familiar, maybe one of them not so familiar. We have an audience poll to help choose the audience pick, and then of course we have tried not to leave these sessions without answering all of your open questions, or at least letting you know that it's a question that we'll have to research before we can give you a good answer. This is a demonstration. Everything we're doing is a demonstration. We've been doing it for quite a while now, and we're basically asking our Knights every month to give us their single favorite investment for that particular month. We're creating a portfolio a little bit different from the kind of portfolio that your club might create or that you as an individual might create. We call it a tracking portfolio. Basically, it's just keeping track of all of the picks that we've made over the years, and then we're trying to see how well it does. Our goal is to have a relative return of 5%. That means we'd like to, over a long period of time, beat the market by 5 points, no matter where the market happens to be. We're comparing against the Wilshire 5000. We'd also like to set a goal of having about 60% or better of our stocks actually participating in that outperformance. So let's look at where we are tonight. Our rate of return has increased again. We're at 13.1%. That's pretty good since inception. Our relative return is about 3%. That means the markets over the time that we've been doing our experiment have grown at about 10.1%, and we're beating that market by about 3 percentage points. Our performance accuracy is just a touch under 50%. That's a little bit beneath where we'd like to be, but we think that both of these things are pretty good. And I think we've been doing this for such a long time that sometimes when we say 13%, we get a yawn from folks. The round table, beating by 13.1%, beating the market by 3 points since inception, yawn. But you know, you need to stop and ask yourself, how good is that really? Only 39 of 26,433 funds have a trading performance better than the round table. 39 of 26,433 beat what these four amateurs are doing here on a monthly basis.
And our guest damsels and guest knights.
And our damsels and knights as well.
In the audience. This is a community effort.
99.9% of all funds are not doing as well as this tracking portfolio.
And, on this one, Ken, maybe this one gives me a little bit of goosebumps, but man, I've run into this, that 3% yawn, I don't think people realize. And that's why when you hear us grabbing for every extra percent that we can and stuff that we're trying to do, I mean, look how special that is.
And we have to understand that we're inviting guests to come into this experiment on a regular basis. We're inviting the audience to do 1/5 or 1/4 of the choices every single roundtable. And I don't think any of the four of us are spending all of the time we have trying to figure out what's the best stock to put into the roundtable portfolio. I must admit, and I'll probably have at least one other guy on the panel, maybe two, that will let you know that if I have thought about my roundtable stock more than 36 hours before I send the slides to Mark, that's a long time for me to think about it. Cy, is that coming close for you as well?
I would say that's about accurate there, Ken. About 36 hours.
All right.
Hugh is about 36 minutes.
Okay. Hugh has a much shorter time frame, right, Hugh?
Yeah, exactly.
I don't think he ever stopped.
Mark, how about you, Mark?
Well, pretty much the same thing. I try to spend the last day or so, but again, keep in mind it is supposed to be our single, standout idea at this time. So that doesn't bother me a whole lot.
So we have Mark, I'm going to turn this slide over to you because I know this is one that you've put together. So why don't you talk to us about this slide?
Okay, this one actually goes back. Ken has been dancing around it. This is our 7th birthday, so we have 7 candles on the birthday cake, and we can actually go back to what I would call the original 4 stocks, the fabulous 4. These are the 4 stocks that were chosen 7 years ago on July 30th, 2010, and we had Abbott Labs, BioReference Labs, Eli Lilly, and Stryker. Interestingly enough, they're all from healthcare. And you can see this is how we keep track of every decision, whether it's made by one of the 4 of us, or a guest damsel, a guest knight, or the audience itself. Anytime a decision is made, we basically log it in and keep track of the price performance. Now, it is including its dividend and split adjusted, obviously. So we're looking at a total return situation here. Here's the 4 stocks that we chose back, again, 7 years ago. 3 of the 4 have outperformed the market, but that's not the whole story, by the way. One of them is still active. My selection of Stryker made 7 years ago is still active in the portfolio. $1,000 invested in Stryker 7 years ago is now worth $3,502 that you can see in that value column. The other 3 positions have been closed out. We really wrestled over Eli Lilly, and you can see from the graph there that Lilly has actually done pretty well since we did close it out. It's been kind of flat the last year or so, but Hugh has been quite an advocate for Lilly over the years. Abbott Labs, that red line in the graph down below, that's a big charts graph, that doesn't also reflect the AbbVie. If you put the AbbVie spinoff in it, you end up with a positive return. And the point I want to make about BioReference Labs, Cy first brought it to the round table back at that meeting. I believe it was selected another 6 or 7 times by participants at these roundtables. But the thing to really remember about BioReference Labs, first of all, that is just one of the positions. Second of all, it's representative of the type of apparently excellent, leadership company, even though it's a small company, a rapidly growing company. And if you actually stack up all 7 or 8 positions, I think we came out with a market-beating relative return of 4 or 5% when you looked at it, all 7 decisions combined. So even though that one came up just a little bit short on that one timer, there were a number of times when it outperformed. So you basically are getting a look at how we look at a position, closing out a position, or how we track them over time, and we're quite happy with the 4. By the way, annualized rate of return on those 4 selections is about 14.5% right now. So pretty happy with that.
This is the top half of the entire list. If you want the entire list of roundtable stocks, that URL at the top of this slide, manifestinvesting.com/dashboards/public/round-table, that URL will, for free, no cost at all, will take you and get you a list of all of the stocks that are in the tracking portfolio. These are just the ones that are worth the highest value right now. This must be the top, the top 20 mark, is that right?
Yep, it's the top 20.
The top 20, and if you take a look at it carefully, you'll see some names that you really respect and some names that have done quite well. There's a legend down at the bottom of this particular slide. That legend also appears when you download the dashboard from the Manifest site, and the legend tells you how many times we've chosen some of these. Our biggest stock, our biggest holding is in Cognizant Technology. That's been chosen 12 different times over the 7-year period, and that $12,000 is now worth $21,600 plus in the portfolio. Some of these that are on this list have only been chosen once or twice, and they've really had some appreciation going on, but you can go back and forth, look at the legend, look at how many times they've been chosen, and you can see some of the ones that we should have chosen a lot more than we did. And you can also see the bottom end of this chart as well. Not everything looks as good as this does. Notice that the quality for the most part in the top 20 holdings is pretty decent. It averages just under 85, and the potential annualized return, the par value, which is the same thing that you calculate right on your SSG, really is fairly decent for just scoring this by the top 20, just picking the top 20 off the list. It's 9.7% for this grouping of stocks. So this is just there for information. We urge you to go to the public dashboard and take a look at the entire group of stocks if that's interesting to you. We're experimenting right now with, we don't actually even have a name for it yet, do we, Mark?
Well, we sort of did.
We're experimenting. Okay, go on. What do you think the name is?
The thing we kind of came up with as we prepared for the National Convention a few months ago is this is really a rule of 5 moment. And
okay,
what we're looking at is the stock, which you can study to your heart's delight and do everything right. Prepare as carefully and as diligently as possible. Every once in a while, one just misbehaves. So that's what we're kind of looking for here. I mean, we're looking for stocks that we've been holding for less than a year that have trailed the general stock market by more than 20%. And when those situations present themselves, we're basically asking this series of questions. Is it a core holding? If not, if it's a play stock, like I'm bringing ZOES Kitchen tonight, that's not a core holding. If ZOES falls faster than the market by 20% here over the next few months, we would walk away from it in a heartbeat. If it is a core holding, we want to make sure that the return forecast and the quality is not degrading. And if that is still intact, then we want to say, well, what's been going on with the industry, just so we have a feel for which way the wind is blowing, and then, of course, watch these that have behaved and performed weakly from the performance standpoint. As you guys all know, sometimes the stock prices don't follow. They deserve to be higher than they are. They lag while the operating performance of the company continues to be strong. So it's just a matter of being vigilant about those fundamental operating characteristics and just paying attention to that effect. So we have actually seen a gain of anywhere from 1 to 2 to maybe even as high as 3% on the experimenting that we're doing on these portfolios. And as you saw from that wow slide, that type of number can be huge.
We have 2 companies that either were on that hot seat based on that flow chart we just talked about, or that are on that hot seat. If you remember last session at the June session, right? we decided to sell eGov. We sold just 2 positions. I think we had maybe 6 positions in eGov, maybe 5 positions, but we decided to sell just 2 of the positions that had a relative return that was greater than negative 20%, actually less than negative 20% because we're going in the negative direction. Novo Nordisk had been on that hot seat a couple months earlier, but had moved itself off of the hot seat, and at the moment, it's not something we're considering selling. But eGov continues to have some problems. The price has moved down to $16 and change now, and I would put on the table that we sell the rest of our positions in eGov, and then we'll talk a little bit about what might be going on with eGov. Is that okay, guys, to put it on the table like that? And then, Mark, why don't you talk a little bit about what you found out and then I'll talk a little bit about what I've read about eGov as well.
Well, what it comes down to is this is a company that's looked pretty solid over the years, and there's no glaring issues. So we had to dig pretty deep. Keep in mind that we're looking at, this is a month-old slide. We just wanted a reminder that we actually debated, almost skirmished over, what do? You sell the 2 fairly new positions? What about the other 4 that have been around for a number of years? And, in this case, eGov actually did proceed to drop another 17% from the last month's meeting. And the market's actually gone up a couple percent, so it's actually dropped another 20% relative. So we actually come out ahead on these 2 positions we closed out pretty favorably. What we found out, we had to dig pretty deep. There were a couple analyst downgrades that generally don't disturb us too much. In fact, sometimes an analyst downgrade will create a buying opportunity. But what we did discover is that there is some fairly legitimate and perhaps even material concern over the contracts that this company has with the state of Texas, texas.gov. And they were, I don't know if it was forced, Ken will tell us here in a minute, forced or if it was just a natural process, but 20% of their annual revenues are at stake here. And now they have at least some level of competition that is making the analysts who cover the company skittish. So again, 20% of revenues at risk here in the near term. And that is a lot of where the pressure on the stock price is coming from. And Ken, I know you had actually had an opportunity to dig even a little bit deeper than that.
Yeah, it's not so much that there's a competitor out there waiting to swoop in and take up this particular business. The government, however, the Texas state legislature is debating with a lot of their vendors about whether they can do the same thing in-house for less money. The analysts that I've read seem to think that is something that, as far as IT and these portals that are being created, will be very difficult for the state to do and to save money at the same time. But the analysts are also very clear that state governments don't always do what is logical. Right now, the Texas contract for all the portals that it operates for the state of Texas is 22%. By the time the contract is renewed, they expect the Texas business to be 19 or 20%. The percentage goes down as eGov grows, creating portals outside of Texas. Texas is the first mega state, and that was a term used by one of the analysts that I read. Texas is the first mega state to use eGov. The 5 big states, California, Texas, Florida, New York, and Illinois, of those 5, only Texas uses the services of eGov right now to run all of its consumer portals and all of its business portals. A lot of the business that eGov does isn't with individual clients, individual citizens. A lot of the business is with other companies. For example, one of the portals communicates what's happening to your driver's license points as you accumulate those points, and it communicates with insurance carriers throughout the state so that the insurance companies can get the information about the infractions that various drivers have done, have committed. So there's a lot of business that these portals do with other businesses as well as with individual consumers within the state. Yes, you can renew your hunting license, or you can register to vote, or you can renew your driver's license. That's the consumer kind of portals. But the other part of the business is just as important to eGov, and that's communicating with other business. I still think the business model is very, very solid. The way they set these portals up is that eGov comes in and sets up the portal, puts in about $1 million of its own money, sets up the portal, and then as the portal gets more and more use, and as the number of portals expands, eGov takes a cut of what's coming in for the fees that are charged, and the state also gets a cut of those fees. I think that some states are looking at the fees that they give to the vendors, and Texas at least is saying, could we do this ourselves? That'll be the decision that they have to make by 2019, when they finally have to renew this contract. So we're going to have some upset in the aura of eGov for the next year and a half or so, maybe the next year, until the government actually awards this contract. If it awards the contract to eGov, I expect almost an immediate move upward in the stock, back to the levels that it might have been trading at 6 months ago. But if it does lose the contract, I think by the time that decision is made, if it loses the contract, then I think that a lot of the downward side will be boiled into the stock, because it's lost a fair amount of its value in a relatively short amount of time. So I'm suggesting we freeze the other positions in eGov for the moment, and we keep an eye on what's going on with the business. I certainly will keep an eye on it, because I think it's a very interesting stock with a decent future ahead of it. But right now, I don't think it belongs in our tracking portfolio based on the rules that we're kind of experimenting with right now.
I guess I'd like to hear either Cy or Hugh comment on the situation.
Well, I think last month I had no problem with the experiment and selling based on the flow chart to see what happened. And I think if I have a critique of the experiment, is that you do split holdings by lots, because I mean, to me, a holding is either a sell or a hold, and I don't see how lots should make a difference. So I would concur with the analysis that we've gone through with selling the remaining holdings.
And Cy, I've come down firmly on what you just said on your side. When I had a couple of weeks to think about this, I agree that these lots are very artificial, and either we're going to sell the whole thing or we're not going to sell it at all. Yeah.
Yeah, I didn't know anything about the company maybe 2 years ago. But yeah, the argument does make sense.
You know, I guess my only argument would be, if the damage has been done. It's that age-old argument of how far does it drop back?
Yes.
Well, this is. I'm going to take a look at a quick price chart over here just on the side.
Yep. Of course. Now, one thing, and I don't disagree with that, Mark. I mean, y'all quote me, and I still proudly proclaim patience, and I think that is important. But if I remember the exact dates that Ken was talking about, if this disruption in the force is the result of a Texas question that won't be resolved, at least a good chance won't be resolved for what, 2 years? Didn't you say 19?
Yeah, I actually think the contract will be awarded in a little bit more than a year, Si.
Okay.
But it won't be effective until 2019.
I got you. So the impact on the financials would be deferred to that point, but
Right.
the outcome would be known sooner.
Yes.
You're giving up significant. If basically you've got dead money for 2 years, you're giving up, or potentially 1 year. One year, my argument's not quite as strong, but you've got a lot of opportunity cost there to sit on known dead money. If that's again what you think's going on. Now, I also am very quick to say, in fact, I think I said it this past weekend at the Georgia chapter education fair, that stock prices tend to move very quickly, both up and down. And so, if we say, gee, we don't see anything happening for a year, we may be right and we may not be right. And it decides to recover in the period of a week or two before you have a chance to do anything. So.
Well, this feels like a case of I was for it until I was against it for me. If I could have known a month ago what we know now, I would have said sell all 6 positions, but we can't go back to that moment 20% ago, unfortunately. But I agree with the motion anyhow to step aside, because I think I learned my lesson on Strayer education. So we'll go ahead and do that. We'll close out those other 4 positions and move on from there and come back to this if they prevail in Texas and continue with a solid-looking business going forward.
Yeah, I think, Mark, what else could change that business model if they should get a contract in one of the other 4 big states. That would dramatically change things as well. Go to New York or Illinois or California, and you and I both had kind of shuddered when we talked about them moving into Illinois or California.
Well, yeah, because it's nice to get paid.
So, yeah.
Yeah. All right.
And that's with all apologies to any of you that live in Illinois or California.
Trust me, anybody who lives in Illinois agrees with us, Ken.
Okay.
All right. I think we better press on.
Okay, so here we also have our rule 1, and remember, rule 1 is right from our investor's manual, and you sell to make the portfolio better. And we have a couple of stocks sitting at the bottom of the par list right now. Nothing that we can determine that's bad or wrong about any of these stocks sitting at the bottom, except that maybe the market has handed us a little pile of money. Maybe they're a tad overvalued for what's going on. Deere is sitting at the bottom of the par list with only 3.3% par. It's pegged to grow at 5%. And Mark, I didn't add Deere at any time. I didn't talk about Deere. You want to walk us through Deere here?
Yeah, and I think there's a sheet on the next page. It shows kind of a flat line. It's definitely not an exciting growth company, and nothing wrong with this company. We don't mean to be picking on Illinois here, but there's absolutely nothing wrong with this company other than it's going to be vulnerable to economic cycles. What you need to know about our situation here is both Kim Butcher and Hugh McManus added this stock to the tracking portfolio. Kim about 5 years ago, Hugh about 3 years ago. Those $1,000 positions have both beaten the market. Kim is up about 1.5%. Hugh is up 11% better than the market since the time that he made the selection. So we're talking about 2 successful positions. And the other thing that you need to at least factor in is I think that 5% growth estimate is probably a little bit robust, and it's probably a little bit less than that. You start pushing the growth rate less than that, and you start getting into a return forecast approaching 0 or less. So I think this is one of those where you're standing around the water cooler trying to manage a portfolio. You simply high five and move on and celebrate the fact that Caterpillar was up 4% yesterday. So that would be my assessment of the situation. This is 2 wins here for the portfolio.
Hugh, you have skin in the game on Deere. What do you think about freezing these positions? You might be muted, Hugh. We're not hearing you.
Yeah, sorry, I wasn't muted. The phone had locked. Yeah, it's a good question. I mean, Deere probably has some place to go, but I'm not wedded to this particular company. I mean, it's going to be slow, and there's a good chance actually that the price will come back down again. Could be another buy, you know.
Yeah, I would agree with that. I mean, as you've shown with Caterpillar also.
Mm-hmm.
Cy, can you support freezing these, Cy?
Yes, I can, and in fact, I would tend to. What I feel about Deere tends to also go with Stryker and Oracle as well. I don't know what our positions are as far as relative return on them, but when you've got significantly below my par, and I think all three of those positions are about half of current my par, coupled with very slow growth. I mean, 5 for Deere, 5.5 for Stryker, or 5.2 for Stryker, and 3.9 for Oracle. There's not a whole lot of upside there. I mean, you make a return with those companies by buying low and selling high, and when you've got the par where you are, there's not, there's no PE appreciation, is what I'm saying. That's where you're going to make your money, and it's just not there. Because there's not the sales growth to drive the price. So I would agree with freezing
right.
Deere, and it would also go with Oracle and Stryker as well. I have a little bit more concern perhaps with Oracle, just because I'm not sure exactly what's going on with Oracle. But even assuming all three of them are just fine companies, that low a par coupled with that low a growth rate, I think it's time to sell.
Oh man, here we go.
I can support that, but I know Mark likes to move a little bit more slowly. What do you think, Mark?
Well, this is one of those situations where I think back to a 1995 investment club meeting where we had the audacity to think about selling Disney, and one of our club members threw themselves on the living room floor, face down, and basically resisted it. And this is an emotional moment here, guys, because this is one of our original four. I can tell you exactly how much it's up because we talked about it a few minutes ago. Oh boy, this is a tough one. It's another successful single time selection. So, wow.
Why don't we split the question and do Deere tonight and promise to look at Stryker and Oracle next month?
Well, they're probably gonna end up there anyhow. But with my luck in the world of investing, we would pass on it, and Oracle will drop 30% between now and the next week. No, I think in order to make a point about the discipline, keep in mind that our overall portfolio is slightly under 10% for the return forecast at 9.7. We really want to see that up around 11.5 as a minimum. The only way
our sales growth is a little bit low too.
Right, and I think we'll probably address that tonight with the stocks that we pick. But boy, this is a tough one. I mean, in a real money portfolio, I couldn't see myself pulling the trigger on Stryker, but in this case, we got to follow the discipline, and I'll simply lick my wounds, and we'll celebrate the victory, but also look for an opportunity to bring this company back when it makes sense to do so. And I guess that's what it comes down to. The lesson is Nicholson taught us: buy and hold, dash for as long as it makes sense to do so. And maybe it's time for a Stryker to have a timeout and watch for the next time when it makes sense. Ouch.
Okay. Any objections then to freezing Stryker and freezing Deere and freezing Oracle's positions? Okay, then that's what we'll do.
Okay.
And we'll move on and listen to a presentation on one of our faster grower companies, and this one was going to be from Cy. And Cy, if you just tell me to change, slides whenever you need to, I'll be glad to press the button. Okay.
I'll be over here with my martini.
Yeah, that's right. I'm sorry, Mark. My brain was frozen there for a minute. I'd forgotten that we had just celebrated happy birthday to Stryker, and
7 years
and
ago.
I go with it.
Okay.
Yeah, I'm glad I'm in Atlanta and you're Michigan, because I'll be feeling hands around my neck or something right now. But so You just saw the up, straight, and parallel bars for Priceline. The first couple of slides just recount how I found Priceline this month. I just took the the roundtable portfolio and ranked it by growth, because I had made the observation that Ken just made that our par and growth are both a tad low. So I was looking at prospective high growth candidates with good pars to accumulate. And you can see, if you just kind of, this is ranked by growth, so do what I did, just kind of take a look for blue and green, or possibly blue and yellows in those last two columns for quality and par. And I have put little red marks next to what made me pass on that company. Mercado Libre, I'm not quite ready. Number one, I'm not quite ready to speak Spanish on an internet company, but also the projected PE was a bit rich for my blood at this moment. EPAM, I didn't want to hear CTSH all over again, and being stubborn, not just patient or persistent. So I figured we'd pass on EPAM, although I think it is a solid candidate. Aerodex, notice the low quality. Ulta Beauty, I know next to nothing about, and if I don't quite have the retail knee-jerk against that some people do, obviously, since I'm picking a retail company tonight in Priceline, but Ulta Beauty is one that I'm just not real comfortable with and not knowing. Stella Jones looks rather interesting. I'm not familiar particularly with Stella Jones, but the numbers look rather intriguing for this wood and lumber company. So that's something to look at. But again, the yellow was a little bit of a reason to perhaps stay away. And so that left then of the blue greens Priceline in the portfolio. Next slide. Next slide. Ken?
Yeah, I'm trying. There we go.
There we go. All right. Yeah, I was afraid maybe, although y'all weren't hollering that you couldn't hear me, I was afraid I'd gone away. Then I took the essentially Priceline's par and quality, plugged it into a stock screen just to see if there was anything else outside the portfolio that might be out there. And you notice there are a couple that at least weren't showing on the high growth. Starbucks is the main one. The Mercado Libre, again, Facebook is a little trendy for me, and Maximus I wasn't ready to bite on. So it kind of Starbucks and Priceline were possibilities, but again, notice I was going for growth, and Priceline has more growth, so I decided to stay with Priceline. Next slide. And then there we are. Just a quick industry study, again, to make sure that there's nothing in the industry that we're buying, at least if not the top company in the industry, certainly an industry leader. And you can see Priceline and Mercado Libre are the two quality companies, and also the best on pars. So that all of that confirmed Priceline was a good buy. Interestingly, Ken, I kept running across Gentex as well, and that was a close second, but I noticed your pick tonight. Next slide. Just a real quick overview. I think I've got about 3 or 4 slides here reminding everybody of what Priceline is. I think we all know it pretty well, but I wanted to give you plenty of reasons to vote during the poll for Priceline. It's, as you can see here, the largest global travel company. It and Expedia.com are both have about 30% of the market, and those are the two elephants in the industry. You get past them, and the market's very fragmented. It's a global company operating in over 200 companies throughout the world, and so they're very geographically diversified. Although when I think of Priceline, of course, I still tend to think of William Shatner and the old name your price model, but it's much more than that, as you can see with these brands, the Open Table, Priceline, Booking.com, Kayak, and so forth. Next slide. Just again, quick company highlights from the company's point of view. They believe they've got significant opportunity to continue to grow, and I believe the next slide will reveal a little bit more about that. Again, a global company. They're one of the largest, so they got tremendous scale. And something that the analysts look at on them, and they mentioned somewhat in the scale advantages, Priceline has the power on both the demand side and the supply side. They have such a buyer's customer base that they can that they have significant power over the hotels and the airlines and so forth, principally hotels that are seeking to reach their market. But then the reverse is also true. The supply side comes to them as well because, again, of this large customer base. Next slide. Here is the opportunity that they were talking about. The top number is the worldwide bookings and accommodations. The yellow is offline bookings, and the blue is online. You can see that it's growing very quickly. The black dashed line is the percentage of online bookings as a percentage of total bookings. And notice while it has more than tripled in the last 12 years, notice it's still only 35% of total bookings. So clearly people are becoming more and more willing to do their bookings online, and that again gives tremendous growth opportunities to companies like Priceline and Expedia. Next slide. Again, just a visual of how globally diverse it is in all of the major developed and some lesser developed areas. Next slide. And then the bottom line, which are our three judgments. I projected sales growth at about 15%, which I believe tracks manifests consensus figure. Net margin at 28, which I think is a little below the consensus. I was a little more conservative on that because, as you can see, that is some margin growth. Right now, Priceline is sacrificing margin to do some acquisition and marketing. And so pretty much uniformly, everybody expects margins to expand. It's just a matter of how much. And I was a little more conservative there than perhaps the analysts are. And then PE forecast, that's right at, my 25 is right at the median for the last 10 years, which seemed very reasonable. Notice it is significantly lower than the current PE. So there is some potential for some either a significant period of flatlining on the price while the earnings catch up, or potentially a price dip to bring that PE back down. But again, the bottom line is the bottom line. We can still get, even with those projections of a PE contraction and lower net margin than perhaps the analysts, still an 11% annual return, and boost our sales growth a bit. So Priceline is my pick.
Thanks, Cy. We're going to move right into my choice, and I'm choosing Gentex tonight. I've added Gentex 2 or 3 times over the last 7 years. This slide basically is right from the Gentex website and shows the history from 2001 out through 2016. It shows the growth of the company. It basically shows the growth in the markets as well, and you can get this slide right on their website. But this company has a very interesting and significant pattern of growth over the last 15, 16 years. What's interesting recently, and it's happened a number of times in Gentex's history, is that their growth is outpacing vehicle production growth. So this graph is graphing growth, and you can see that growth is predicted by the company to end up somewhere around 8 or 9% going into the future. Meanwhile, vehicle production growth is slated to be somewhere around maybe 1.5, 1.75%, and the vehicles that Gentex works with are slated to grow maybe only at 1% or even a little bit less. So that means the company is putting more content into the vehicles that are being produced, and it's growing the content that goes into the vehicles faster than the number of vehicles because its production is growing more quickly. It's important to understand this is not just an electronic mirror company. They do a lot of work with mirrors, but about 50% of their revenue comes from adding advanced features to an automobile. And some of those advanced features are these full display mirrors. They're going to be mirrors that do all kinds of things that right now our mirrors don't do. I think that, if you would have said 15 years ago that your mirrors would have helped you determine what's in your blind spot, people would not have been ready for that. But today, those are pretty standard mirrors on a lot of cars. And these types of added features are going to be really coming quickly through Gentex and into a lot of automobiles throughout the world. Cameras, for example, and camera monitoring systems are going to become very common on mirrors as we go forward. They were first shown in 2017, this year, and they're already being added to some of the high-end cars in some of the manufacturers throughout the world. Gentex does not just operate with the big three in the United States. Gentex is a worldwide player and operates with almost all of the automobile manufacturers throughout the world, including many of those in China. The HomeLink, which originally was just a button to help you open your garage door, Gentex has bought HomeLink from Ford Motor Company, and HomeLink, along with Bluetooth, will connect the entire house to your automobile, and in all likelihood, those things are going to be controlled through your rear view mirror. Again, something that we would think was science fiction 15, 20 years ago is now going to be doing things that you never would have guessed. The integrated toll module I found kind of significant. Their toll module will speak to all of the different toll booths and toll collecting electronics throughout the entire United States. Right now, for example, I have Easy Pass, and Easy Pass is in the Midwest and into the Northeast, but it's not nationwide. There are two major platforms for these toll modules, and then a lot of different brand names for them. But again, putting this into the mirror so that you have an automatic way for your car to be recognized and for the toll to be charged. That's going to be happening. It is already happening, and they'll be rolling out an actual product launch. They're testing it right now, and the product launch will be sometime during 2019. They're also experimenting with biometrics so that all of these things will be tied not to passwords or mechanical buttons or anything like that, but tied to biometrics. Maybe it will be a retinal print. Maybe it will be a fingerprint. We're not quite sure where it's headed, but Gentex is working on iris scanning technology that will allow all these different things to eventually happen, and maybe make it much more difficult in the process to steal a car as well. This graph came from Gentex in the 2016 fiscal year when they were making some guesses as to where their revenues might move. you'll notice that their most recent forecast in January of 2017 was $1.78 to $1.78 to $1.85 billion in sales. This 1679 was the 2016 sales number. So you can get a rough idea of where the company thinks it's going to move. And then just a couple of days ago, Gentex reported their second quarter. They were profitable. They did have some growth in both quarters. There was a major share repurchase during the quarter. And what was significant was that they repaid a huge piece of their debt. And that is expected to really boost earnings going forward without these debt payments to have to worry about. The calendar year guidance has been narrowed a little bit, but it's still in that 1.79 to 1.83 range. Notice they up the low end a little bit and lower the high end just a touch. So the middle is not too much unchanged, a little bit unchanged, but not too much. So we're still anticipating significant sales for the company. Here's the Better Investing SSG Plus tool. You can see that we're certainly looking at lines that since the Great Recession have been showing a lot of significant growth. I projected 8% growth for earnings and sales. That's very conservative when you look at the analyst community. But I was looking to see what would happen if I did an extremely conservative SSG. Would I still end up in a place where I might want to buy the company? The pre-tax profit margins seem to be moving in the right direction, as does return on equity. And I've already mentioned the debt is moving in the right direction, the trend on debt. That latest debt repurchase is in this fiscal year, so isn't even reflected on those numbers at the bottom of the page here. Here's the PE values. This is an auto supplier, although Manifest Investing classifies this as an electronic company. And I think you could make a good case that this might fit into some of the different tech industries as well, much more than just an auto supplier. But the major classifications place it as an auto supplier. Notice that its current PE down around 13.5 is significantly less than its average PE, which has been around 16.5. So that might indicate that it's a really good buy right now. I've done the projections right here on PE, and I've chosen a high PE going forward, significantly under the 5-year average. I've chosen 17, and I've kept the 5-year low average at about 12. I'm getting a buy, a pretty good appreciation, a par value of 12.2, a total return value of 15.2. I like to think of my possible return in between those two numbers. So I'm pretty pleased with what this is doing. I then went for some validation to the Manifest site. Here's the Manifest Eagle. This is the default numbers. Notice that the analyst's opinion for growth is around 10% rather than my 8%. And the analyst's average PE is around 16, and I think mine is a little bit lower than that. I do agree with the net margin call going forward of about 22.5, so I didn't touch it, but I did adjust the sales number down to 8. I adjusted the PE number, the average PE number down to 14.6, I think it is right there. And that still gives me a 13.4, which is right smack in the middle of those two numbers that came up on my SSG. I'm very pleased that I'm getting validation from the Manifest site when I'm looking at the same stock. So I'm going to suggest we add another holding in Gentex. I went to the company page itself. This is certainly a high quality, certainly a decent par. Manifest is predicting almost 17% par. Like I said, it classifies Gentex as an electronics company. and it likes these 5 electronics companies the best in that industry. Gentex sitting at the top of the heap, and in technology, it picks the 5 companies it likes the best, and Gentex is sitting at the top right there in the tech field. So I'm pretty pleased that this stock has the potential to make some good money for us in the next 4 or 5 years. So I'll give us a position of Gentex. Mark, we're on to you looking at Zoe's Kitchen.
Okay, thanks, Ken. Okay, what I'm going to do is just step fairly quickly through one of my favorite practices. A few slides ago, we talked about how the performance of the roundtable tracking portfolio had been beaten by only 39 mutual funds. Some of you probably wondered, wow, I wonder who those 39 are. Well, here's some of them. These are at the top of the list. This is a list sorted by Morningstar's star rating system. So you can see the 5-star funds are up at the top. And one of our perennial all-time favorites is in the number 2 slot there. Brown Capital Management as a source for small company ideas. That's where we're going to turn to check in and see if we might have something to shop for. I do find it interesting looking at the 10-year returns, and then I'm really glad Hugh was with us and that he is willing to select some healthcare companies from time to time, because look how these companies or these funds that have specialized in healthcare have done over the last 10 years from top to bottom. And notice that, by the way, the only general fund on this list, a company non-sector fund investing in a variety of things, all of the above investing, is Brown Capital. Go ahead, Ken, take the next one. Next slide, please.
Yeah, I'm trying again, Mark. It's giving me some issues. There we go.
All right, just for kicks, I took a look at the roundtable tracking portfolio, noticing that concentration in healthcare and technology, and noticed that here is our portfolio and the sector distribution showing the technology and healthcare contribution to the portfolio. This is not terribly different than a lot of the club portfolios that we encounter in our jamborees and dashboard diagnostics, that sort of thing. I would consider this to be a fairly well-positioned portfolio, at least by sector. Nobody really dominating, and no, that's not too much technology, in my opinion. Next slide, please. Well, here's a thing you can do at Morningstar. You actually go into the Brown Small Company Fund and look at the holdings. And in this case, I've sorted by when they bought. By the way, there's only 40 companies in the portfolio. And you get down this list very far, and you're looking at stuff that they bought, 2006, 2002, that sort of thing. But what we're interested in is new ideas. And at the top of that list, you see cardiovascular systems. That could be a good study. Ironwood Pharmaceuticals, you may have something to say about that one. Paycom, and then down here, I wanted to kind of avoid healthcare and technology if I could. I wasn't going way out of my way to do it, but this notion of Zoe's Kitchen came up. And this company has been massacred over the last year, so we want to take a closer look at what's going on. But again, the concept is use somebody who seems to know what they're doing. Brown Small Capital Management is one of the best funds on the planet, certainly, and they do focus in on the smaller, faster-growing companies. So we are an advocate of watching over their shoulder for ideas to study. So let's take a little bit deeper look at Zoe's. Go ahead, Ken. Well, here's what's been going on, basically from the time that Brown became interested and ultimately took a position that's been going nowhere but south. It doesn't happen to them very often. The company has reached all the way down into the $11 or $12 range, coming from the $40 range. So it's been quite a steep decline over the last year. I will be watching and listening to anything that Keith Lee and his team have to say about this one, but let's dig in a little bit deeper. Notice that that relative strength index has reached the point where it's theoretically oversold. Next slide, Ken. Now I'm going to ask you to think out of the box a little bit. This one's a different type presentation. It is speculation, and we do have some room for it in the portfolio. But what I want you to think about is ZOES is a relatively new company, and you want to think about the types of challenges and the playing field stuff that is presented to a company fairly new out of the box. So I went back and looked at Panera, which, by the way, was just bought out for $315 a share fairly recently, because I just got some of the brokerage statements that did that. And if you go back into the same type of time frame on the lower left there, for Panera, you can see some pretty interesting turbulence in the stock price. Their stock price was cut in half, kind of blasted away there in the late 1990s. Again, for a fairly young company in this industry, this type of disruption can be very challenging. They have their moments. Go to the next slide, Ken. Sometimes you have to re-click. Okay, this is from my collection in the basement that my wife yells at me about. I went into and grabbed some restaurant old value lines and went back and said, you know what, I want to do the thought process of, what if ZOES resembles the evolution over its company life cycle of a company like Panera? What did it look like at Panera when we were the same age as ZOES? And if you look back on the left in the late 1990s, they actually had periods where they had negative earnings. Stock price disruption that you can see right there on the chart that we showed on the stock charts a few minutes ago. But what I also want to draw your attention to is down on that net profit margin line, they came from sub-zero to zero, and then they eventually got up into that 4, 6, 7, 8%, kind of stabilized in that 6% range. And we all know this company well. They ran a good shop, good business. That's why they were taken private here recently. So this is the type of thing that is a reasonable expectation. It is inflation. Can they pull it off? Can they get there? I don't have any idea. But if they do, you're looking at outsized rewards for investing in an early stage company. Go ahead to the next page, Ken. And here's the situation. When a company is at the near zero in earnings, when they're breaking out and finally generating positive earnings, and they take a step backwards, it drives the rhinos crazy. The Wall Street institutions just go nuts, and that's exactly what has happened to this company. You can see the drift down in earnings expectations for 2017. This is from Finance Yahoo. You can see that they've gone sub-zero, so they're kind of at that toggle point where companies struggle. Many companies go through this. But the thing I do like to point to is, forget about the earnings, the top line is still pretty much intact and has not shown significant degradation yet. So they're still chugging along pretty good when it comes to the earnings side, or excuse me, the revenue side. And they're not that concerned about earnings right now. They're trying to grow the business. And that also drives the rhinos crazy. Go ahead to the next slide, Ken. Here's a place you can go for more information. If you go to zoeskitchen.com and look in the lower right-hand corner, you'll see investor relations. They just made a presentation to the William Blair Growth Stock Conference. This is all small companies presenting in Chicago. This is about a month ago. So you can actually take a look. I just grabbed a couple of key slides which capture key moments about this whole concept of thinking about an early stage investment in a company like this. First of all, before we talk about what they actually try to feed us, we have the situation not unlike an O'Reilly or any retailer or whatever, a relatively small geographic footprint with room to grow. You can see that outside of a couple of states down at the bottom, there really are not that many states covered yet, and the Colorados and Californias and Illinois and Wisconsins and Michigans are basically ripe for the taking, probably the Northeast also. Go ahead, Ken, go to the next slide. So room for geographic expansion. What these guys basically do is make good Mediterranean food. It's very healthy. I've actually never been to one, but have talked to some people who have and had a very positive experience. We have similar type restaurants in this area going up around us. I think for many baby boomers, this type of food is quite appealing. I read somewhere in their investor relations material that they really are targeting the females in the 19 to, let's say, 54 age bracket, fairly broad bracket. But what their premise is basically those are the people that will bring them more customers because the moms and ladies will bring more people with them, including families. And that certainly seems to pan out. So it's again, very high quality, kind of a Chipotle type attitude for food quality, but room to grow, as you can see on that geographic chart. So go ahead, Ken. One more slide. Again, not a whole lot of information, but the top line is okay. If they can come along like Panera and at some point in time achieve 2, 3, 4, 5, 6% or more on the net margins, the type of returns that are possible are in the 20 to 40% per year range, as you can see by the quick summary there of the income statement. Again, the 30% return for achieving a 6% net margin out in the future. So again, early stage investing seems to be well managed, seem to be putting something out that everybody likes, and the top line is in pretty good shape. So Let's see if they can't get on a trajectory, very much like an early stage Panera, and we're going to add that to the portfolio and watch it carefully. This is a speculation, and perhaps we can hit a home run with this one. So thanks.
Hugh, it's yours now for General Electric, so take it away. And we're not hearing anything, Hugh, so you might be muted.
I just get unmuted, so I don't have the webinar going, so I have to rely on the fact that some slides. The company I chose is GE. It's a different company that I would generally look at because it's so large, and that to me implies a growth rate which I don't really like. But it is a stalwart, and it's a company that I have in the past. I had sitting in a portfolio. I March, early March of 2009 rather, when for crashing. On the second, you can $250 million. It's huge, and it seems to do almost everything. It has 8 areas where it focuses on, but that's down from about a dozen or more 5 or 6 years ago. It is really focusing its core business into a few areas. It's getting rid, actually, of GE Capital. For years, that nearly actually brought funding in the Great Recession. The area that is surprisingly most profitable right now is power and water, the very first one mentioned on this slide. But aviation is extremely profitable, as is healthcare. It is almost like buying a mutual fund because it is all over the place. And if you skip on to the next slide, where it shows the growth in price over the last decade, you can see that it really hasn't recovered since back in the days of the Great Recession. It plummeted down to under $5 a share, as I recall. I remember the dividend yield was well over 8 or 9%. It was spectacular. But recently, you can see over on the far right, the price has been declining, and there are genuine reasons why that's occurring. But the company is pivoting, as we'll talk about in a second. And I can't imagine that downward trend would last much longer. On the next slide, I just talk about the fact that what's interesting about GE is that it's credited with being an original member of the Dow Jones Industrial Average. However, most sources say it was added in 1907. The index was published from 1896. And there have been 51 changes in that index, and over 200 companies have come and gone in that time. GE has outlasted them all. In fact, you could argue that it is an original. There's no company in the Dow Jones Industrial Average that is longer than GE, and it certainly has gone through many cycles in the economy and done so successfully. And that's one of the reasons that I believe this pivot the company's undergoing now should be successful, in the sense that it has always managed to adapt to a changing environment in the past. And on the next slide, we can just talk about the bad news. The company has returned about 0% or less in the last 12 months. I am accounting for reinvestment of dividends here, so slightly negative actually as of today. And you have to consider the fact that it spent a lot of money buying back its own shares, so the share price should go up as a result, or it should stabilize it, but still there has been a generally downward trend. Right now it has a very high dividend. It's closing in on 4%. That's always very nice. And there are areas where it has suffered. Its nuclear business has been a bit of a mess. The big question that people are wondering is if there is a resurgence of coal, will that threaten the very profitable gas turbine business? But the company is reinventing itself. And as one wag said recently, it's a 120-year-old startup. But the question is, does it have the requisite 5-year financial history that we all know and love? This is a new beast compared to what it was 5 years ago. My argument is I'm not sure to the extent that it matters for a company like this, because it has weathered very many storms in the past. On the next slide, I talk about recent performance, and I code these from different presentations from the company itself. And if you go onto the investor relations section of the GE website, it just is a wealth of information. The sad thing on this slide is that the top line growth has just been 1%, but it has a very strong cash flow, and it has returned a boatload of change to investors in the form of dividends and repurchasing over the last number of years. You'll see consistency, by the way, in all the presentations, which you always like to see from GE when they talk about forecasted EPS for the next year. They're all singing out of the same proverbial hymn book here. They talk about margin expansion at, well, rather paltry number, but growth in cash flow is anticipated, and they are anticipating giving back even more, or they have given back even more funds to investors. Now, GE suffered a lot during the Great Recession, and that's one of the drivers that for this turnaround is the fact that some of the businesses have not performed well. One of the stalwarts for many years was GE Capital, but that is going. And I like the idea that Flannery, good name, could really help GE. And the guy has traveled, has worked in many divisions of GE for the last 30 years. He's traveled extensively in Asia and run businesses there. A significant experience. But they are going to face challenges because one of the core businesses, oil and gas, is kind of weak right now. So on the next slide, really, when you dig into this and dig into what the company's about, you can really tell that they are no longer spreading out, buying more businesses, investing in new areas. They're really delving into the business they already own to try to extract more value. Part of this has been driven by pivots in many companies in this digital age. GE is following and even leading there. And this company spends a lot of money in R&D. Perhaps not necessarily a sign of an innovator, but in this case, GE in many of its divisions has been very innovative. It spent over $5 billion of R&D, a big chunk of its bottom line. And generally, you would hope that those types of investors, except for large pharma, should pay off in the long run. So on the next slide, the question is, how is it going to pivot? And I talked about the challenges that this company faced, and this is from one division of GE, but they have been facing challenges from companies that are analyzing data more effectively and going into GE customers and showing them how to make better use of the assets that they own. GE is following in there. It was very clear that it probably didn't understand its customers as well as it should. And perhaps now it's adding to its mix an almost consulting role, highly profitable relationship type business that tends to be long-term stable. And then on the next slide, just boring you with some numbers, but you can read this slide. It's a little bit squashed, but a little bit small. You can see where they are generating a lot of their revenues from things like power, renewable gas, renewable energy, which is quite an interesting area, and right down to the stalwart business of lighting. Margins are lower in these sorts of businesses. The growth rate might be a little bit slower. On the next slide, we're really echoing back to what has been talked about before, particularly the issue of returning cash to investors. GE says it will continue to do that, another $4 billion or so in stock purchases, and a little bit more in terms of dividends. But on the next slide, where it talks about GE second quarter earnings, you can see that it did quite well revenue-wise. It is a drop over last year, but the fact of the matter is that it is shedding and refocusing business. And its profit margin is somewhat high, 8.5%. In general, its metrics are not good compared to its peers. They could do with improvement. But let's hope that's what this pivot or this reinvention is all about. The 8 core businesses are discussed in the next slide in very small font. My apologies. But they're talking here about the deals that get done, the highlights of those deals. But if we bounce on to where we talk about GE, as reported by Manifest Investing, looks a bit healthier. It's a very high quality rating of 94 and a projected annual return of over 15%. Not bad at all. It's a behemoth, as I said. Its current sales at 124 billion, 125 almost make it one of the largest companies in the Dow, and that's actually less than 50% of the it's just over 50% of the market cap of the company. Interesting metric for me. And then when we go to the next slide, it breaks down the financial strength, EPS stability, etc. And again, this looks not a bad company at all. I'm not as sanguine about the full caps rating. It looks all very positive down there, and a lot of people are very happy about it. But it's nice to know. I would generally take that as a warning if it doesn't show that most people want to buy it rather than sell it. but and most people believe it's outperformed. But I'm a little bit skeptical overall the foods thing. And then when you look at some of its peers as described, or some of its competitors, if you will, as described on Manifest on the next slide, it's doing quite well compared to things like Danaher, etc., and some of the other people in this business. Don't know how it's doing compared to Siemens, which would be its large German competitor. But finally, you can see how the quality, which is the blue line on the chart, and the projected annual return tend to get to the point where they're starting to converge after a little while, or they're drifting apart for a while, if you will. So the projected annual return has been improving as the stock price has dropped, but the quality has remained good, remained stable, which is good. So overall, GE looks like it's in pretty good shape. The big challenge is, will it deliver on its promised pivot or turnaround? And that's a big question. But it does seem to be doing things right. And it did, I remember in the 80s, it used to bring good things to life. So let's see if it can do that for the stock price going forward. So, yeah, boring old company, boring old GE, which I've never really liked because, you know, it's way too diversified. But there you go. It looks to be in good shape and something that kind of interests me this month, rather. So I'll give it back to you there, Mark.
Thank you, Hugh. And what I'm going to do now is I'm going to launch our poll. If I can get it to stay open so it'll allow me to launch the darn thing. Hold on just a second, folks. And there's the poll. It's now been launched, and you can vote for which company you would like to add to the portfolio as well. All you have to do is take your mouse, if you're on a computer, or your touchpad, and press one of the slides. We have 2/3 of the folks voting. We're up to 3/4 voting. Let's see if we can push that up towards 90%, 82%, 85%, 86%. Just take the time to vote. I'm going to count to 10 in my head here and then close it down. Okay, I'm going to close the poll and share the results with everybody. And you can see that we're going to add a position in Gentex. I hope that's showing. Mark, is that showing? I can't see.
Yes.
Okay, great. Okay.
I think they're all good picks, but that Mediterranean food is just calling out to me.
All right. Let's see. Let's go to the next slide. Here's coming attractions. Mark and I are doing an awful lot of traveling in the next 4 or 5 months. So if you're near any of these events, starting with the Cleveland, Ohio, Northeast Ohio chapter on August 17th, we'd be glad to meet with you in the evening. We'll be in Central Pennsylvania, then on August 19th.
And I still have the poll showing. Maybe that's just me. There you go.
Did it close out now?
It's yeah, coming attractions is up now.
Okay, great. And I want to draw everybody's attention to the August roundtable. It's going to be on the 4th Tuesday of the month, which is the normal Tuesday we meet, but there are 5 Tuesdays in August. So make sure that when you look at your invitation, you notice that it's on August 22nd, not the 29th. So, Mark, I'm going to turn it over to you to answer a few questions. I'm going to be away from my screen for just a few minutes, and then I'll be back, okay?
Okay. Let me go ahead and take a quick look then at any outstanding questions that we have. Not seeing any there yet. Just some people giving Hugh some affirmation that the company, the General Electric, has probably been beaten up a little more than they probably deserve. So once again, Hugh is shopping in the... Oh, we have people checking in from North Carolina, from Texas, that say they ate at ZOES and that it was quite good. That's always good to hear. Okay. There is a question from me that basically says, what's causing ZOES to be in that downtrend? And again, I think it has to do with that inflection of, or you can almost think of it as a tipping point where they were expecting positive earnings and they're slightly negative, and that just sends the institutional analysts who follow the company into a tizzy. So you're seeing some downgrades and that sort of activity, but mostly they are probably reacting to that inflection point. Okay, just kind of looking back through the companies, there are concerns expressed by a few people about car sales projected to be down in 17 and 2018, and if that's the case, could there be some pressure on companies like Gentex?
I agree there will be pressure on companies like Gentex, but Gentex has proved that it can add content even and outpace the decline in sales. The last time we had a decline in car sales, Gentex growth stayed positive. It did slow, but it stayed positive during the Great Recession. So I think it's something to think about, but I still think that with a very conservative analysis, this company has room to make some money. Mark, we have a hand in the air from Ann Manning. I'm going to unmute Ann and let her speak.
Excellent.
Ann, go ahead.
Yes, I just have a couple of things on Hugh's presentation of General Electric. He did not mention one area that they're going into is they're merging with Baker Hughes, which is a big company here. They are oil and gas service field company, and I'm not sure exactly when that merger is going to happen, but that is one of the new directions they're going. And the other thing, I was glad to see that the four of you were having trouble trying to sell Deere, Stryker, and I believe the other one was Oracle, because I put a decision that I sold Pepsi this week on Manifest, and I have been struggling whether to do that, and I'm glad to see that y'all also do that. It has been a great company for me, but I didn't see going forward that it was the right thing to do. So glad to see you guys do the same thing.
And I will tell you that Baker Hughes has disappeared from the data feed, so I think that might mean that the merger has been completed.
Yeah.
Okay. Yeah. Okay. Yeah, they're in the area that I live in town. There's a little town called Tomball, and they have a big presence in that little bitty town. So I guess GE is going to be that now instead of Baker Hughes.
Okay, Ann, I'm going to put you back on mute. Thanks for your comments. Joan, you're unmuted. You will be in a second unmuted, I hope. There we go. Joan, you're free to speak if you want to. It's Joan Rusden or Rusden. Okay, I'm going to call that an inadvertent hand raise and move on to the next hand. And our next hand is Norm Chemnitzer. Norm, you're unmuted. Go ahead.
The Badger.
Okay. Norm, can you hear me? You're unmuted. Go ahead. Okay, we're going to call that an inadvertent hand raise as well. And Mark, I'm going to go back to the questions now and try to move through some of the questions.
There's one there that I'll tackle while you're shopping around. The question
okay, great.
Is the September 5th webcast open to everyone or anyone? And the answer is yes. That's going to be an encore performance of the relatively better selling that Ken and I did in Cincinnati. And it's more than that, though. What we're going to begin to try to do is do a little bit more. So most Tuesday nights, we're going to hold sessions, and this is actually the launching session for that practice. So it'll be Tuesday night, September 5th, and Ken and I will be presenting that relatively better selling with any new findings that we have, but again, going back and sharing the stuff that we discussed with the audience in Cincinnati and the stuff we've covered in a couple of cover stories at Manifest Investing. So yeah, we will make that available. We'll probably try to twist size arm on presenting on redefining risk, that type of thing. And Over time, we'll present a variety of subjects on Tuesday evenings.
Okay, Mark Joe Whitaker has clarified his comment from earlier. He says, I thought Mark was going to go through all the stocks tracked by Manifest, trying to flag any stock that has dropped more than 20% compared to the performance of VTSMX. I don't remember promising that. Did you promise that, Mark?
That may be a misunderstanding. We actually track the performance of every single decision we make at the roundtable and track that. We also are tracking it at the monthly stock selections we make, and I'm trying to think where else on the Fave 5 that we put out every week. We monitor that condition for all of those companies, not for all the stocks in the stock market, but we do monitor all the stocks that are featured by us.
Mark, maybe it would be helpful to put 4 or 5 minutes in at the next roundtable and show folks how they can actually track a stock themselves and show it right up against the VTSMX using a free charting service that's available to people.
Absolutely.
Okay, if we could make a note on that, Joe will try to do that for you and show you how you can make that happen yourself. John Radford would like to know, will these slides be made available? And the whole presentation we hope to have up on the YouTube channel. The YouTube channel is Manifest Investing Roundtable, and we're working hard to get them up there. Please remember that most of us are volunteers and that Mark has a full-time job that doesn't involve this volunteer work that we're doing. So we'll get them up there just as quickly as we can. But if you really need something immediately, a note to Mark might get you the slides, or at least a PDF of the slides. And he can be reached at mark@manifestinvesting.com. So you might want to try that if you really need something immediately. Michael is suggesting for us to look at Facebook. He thinks it's a pretty good pick. And he wants to know, Mark, if you know what is moving ZOES to the downside right now. Do you know of any particular item or action that's moving ZOES down rather than up?
Yeah, like I mentioned during the presentation, I think it really is a matter of being at that tipping point where a company is finally starting to make positive earnings, and when they take 2 steps backwards in order to take 3 steps forward, hopefully, it just drives the analysts crazy, and they go stark raving mad when companies take those steps backwards, because it's a very high risk proposition, and hopefully they'll march forward and we'll be rewarded. But that's why they're so skittish.
Phil wants to know, will we be mailing an invite for the September 5th webcaps? Absolutely, Phil. We'll be mailing to our entire mailing list, which is up to about 800 names right now. We'll be mailing to that, and there's no cost at all for that September 5th website. We just would like to have an audience, and the more audience we can put together, the more we can bring you interesting speakers from throughout the country.
If you want to send in $20 in a brown paper bag, there's plenty of room in my mailbox.
Mark will take anything you want to send willingly. Mark Sandra says that she ate at Zoe's this weekend and it was pretty good.
Good.
So you have an anecdotal a person telling you that the food is pretty good as well, okay? I've covered the questions. I don't see any hands raised at this point. So usually when I say that, a question pops up or a hand raises, so I'll count to 10 in my mind here.
I think we're good. Go ahead.
Sharon is just saying that I'm beginning to sound like a disc jockey. When I'm vamping, Sharon, I have nothing to say, so that's what it sounds like, okay? And we're done. I think we're done. We're just getting a lot of thank yous, so I want to thank everybody for coming this evening. Again, a special thanks to Hugh and to Cy and to Mark for doing all the work that they do every month. This is 7 years. I could never have estimated that we'd last for 7 years when we did the first one of these, guys. Thank you so much for all the work you do. It's greatly appreciated.
You're welcome.
Good night, all.
You're welcome. Good night, everybody.
Bye, everyone.